After a decade advising multi-million-dollar businesses and high-net-worth clients across the world, one truth has never changed. Wealth isn't built by how much you earn, it's built by how you manage what you already have. I've seen CEOs earning seven figures end up stressed and strapped for cash. And I've watched everyday professionals quietly build financial freedom, not through luck, but through discipline and mindset. Hi, I'm Fahad, an ACCA-qualified global financial consultant. For over 10 years, I've worked with clients across industries, from fast-growing startups to established investment portfolios, helping them structure, grow, and protect their wealth. And if there's one thing I've learned, it's this. Most people don't lose wealth because of one bad decision. They lose it through small, repeated habits that silently drain their financial potential. In this video, I'm breaking down 9 money habits that keep you broke, and more importantly, how the world's wealthy people break them. These aren't theories from textbooks, they're lessons drawn from real client experiences, from those managing 5-figure budgets to 9-figure fortunes. So, if you're ready to shift from financial survival to financial strategy, let's get started. Let's start with the first and most common wealth-killing habit, paying yourself last. It sounds simple, but this one mindset quietly keeps millions of people stuck in a financial loop, no matter how much they earn. I once had a client, let's call him David, earning over $200,000 a year. On paper, he was doing exceptionally well. But every month, he'd tell me the same story. I'll save what's left after expenses. The problem? There was never anything left. This is where behavioral finance comes in. Humans are wired for instant gratification. Our brains reward today's comfort over tomorrow's security. And unless we design systems to override that bias, even high earners end up broke. That's why the wealthy don't rely on willpower. They rely on structure. They build forced saving systems, automatic transfers to investment accounts, corporate saving plans, or what I call investment auto deductions. The key is to remove choice from the equation. Here's the rule I teach every client. Treat your savings like a non-negotiable business expense, because your future is your most important business. When you pay yourself first, you shift from emotional money management to intentional wealth creation. It's not about discipline, it's about design. The second money habit that keeps people broke is getting comfortable with bad debt. Now, let's be clear, not all debt is bad. The difference lies in what the debt creates. Most people use debt to buy liabilities, things that lose value or generate ongoing expenses, cars, gadgets, lifestyle upgrades. But wealthy individuals and business owners use debt as a tool to acquire assets that generate income or appreciate in value. Think of a client I once advised who used financing not for a new car, but to acquire an income-generating property. That single decision turned a liability mindset into a wealth-building strategy. When advising clients, I always categorize debt into 2 types: productive debt, the kind that produces cash flow, growth, or long-term appreciation, and destructive debt, the kind that drains resources without creating value. Here's the professional rule. If your debt doesn't generate revenue, returns, or measurable value, it's destructive. So how do you fix it? Start with a debt hierarchy. Pay off high-interest, non-productive debt first. Then, redirect the freed-up cash flow into investments or assets that work for you. Because debt, when used strategically, isn't your enemy, it's a lever. But unmanaged, it quietly becomes the anchor holding your wealth back. Habit number 3 that quietly keeps people broke: not having a financial buffer. One thing I've learned advising both corporations and individuals is this: cash flow resilience is everything. Every business I consult for maintains an emergency reserve liquidity that allows them to weather market shocks, supply issues, or sudden downturns. Yet, most individuals don't apply the same logic to their personal finances. Your life is a business. And just like any business, you need a liquidity strategy. For individuals, that means setting aside 3 to 6 months of essential expenses. For business owners or freelancers, 6 to 12 months is safer because your income can fluctuate. The key isn't to rely on what's left at the end of the month, it's to systemize your safety. Here's how. Set up money buckets, an operating account for daily expenses, a safety fund for emergencies, and an investment fund for future growth. Then, automate transfers to each. This isn't just saving, it's building financial resilience. Because true wealth isn't measured by how much you earn. It's measured by how long you can stand strong when income slows down. Habit number 4 that quietly sabotages wealth: not truly knowing your income and expenses. Most people think they have a budget. But when I ask clients for their actual monthly numbers, most can't give me a clear answer. And that's where the problem begins. In business, every company runs a profit and loss statement, a clear picture of what's coming in, what's going out, and what's left to grow. Your personal finances deserve the same structure. I call it your personal P&L. One of my clients adopted this approach, and within 3 months, she increased her investable cash by 18%, simply by reviewing her numbers monthly. No new income, no lifestyle downgrade, just clarity. You can do this easily using Excel trackers, QuickBooks Self-Employed, or even apps like Inab or Notion Finance templates. The trick isn't just tracking what you spend, it's tracking what each dollar does for you. Does it build your future or fund your distractions? When you treat your personal finances like a business, you stop reacting to money and start managing it with intention. Habit number 5 that keeps even high earners broke: expensive hobbies and lifestyle inflation. I once worked with a senior executive earning 7 figures a year, yet every month his account balance hovered near zero. Not because he didn't earn enough, but because his lifestyle kept expanding to match every raise, every bonus, every promotion. That's what we call lifestyle creep, when your spending quietly grows in step with your income. The wealthy avoid this trap by understanding the relative wealth concept. Wealth isn't your salary, it's your assets divided by your liabilities. You can earn $1 million a year and still be broke if you owe two. But you can earn far less and be financially free if your assets consistently grow faster than your expenses. Here's the rule I give clients. If your lifestyle inflates faster than your investments, your wealth is shrinking. Enjoy your success, absolutely, but build a system where luxury follows growth, not emotion. Because financial freedom isn't about denying yourself, it's about ensuring your money works harder than your lifestyle does. Habit number 6 that quietly limits financial growth: believing that saving alone will make you wealthy. Don't get me wrong, saving is essential. It's the foundation of financial stability, but it's not the engine of wealth. Over the years, I've met countless clients who saved diligently for decades, only to realize their net worth barely moved. Why? Because their money was sitting still. True wealth begins when your money starts working for you. Here's the reality. Every dollar you leave uninvested loses value every year to inflation. That's the hidden cost of safety, what economists call opportunity cost. The wealthy understand this. They don't save just to hoard, they save to deploy. Their savings are simply fuel for the next investment, whether that's stocks, real estate, or business growth. So remember this rule. Saving is step 1. Investing is where the wealth begins. Build your safety fund, yes, but once that's secured, move your money into assets that grow, compound, and multiply. Because wealth isn't built by what you keep, it's built by what you make your money become. Habit number 7 that quietly drains wealth: paying too much in taxes. Now, let's be clear from the start, this isn't about tax evasion. It's about tax efficiency, legally minimizing what you owe by structuring your finances intelligently. As an ACCA and global consultant, I've seen this play out across dozens of markets. The wealthy don't avoid taxes, they plan them. For example, we once helped the small business owner reduce their effective tax rate from 42% to 27%, not through loopholes, but by restructuring how income was classified and reinvesting through compliant channels. That's the difference between reactive tax payment and proactive tax strategy. Key tools include tax-deferred investments, business expense optimization, and dividend versus salary planning, each designed to align your earnings with how the tax system actually works. And here's a mindset shift. If you're earning 6 figures or more, a qualified tax advisor isn't a cost, it's an investment. Because every percentage point saved in tax is capital that can be redirected into growth, compounding year after year. The wealthy understand that tax planning isn't just compliance, it's strategy. And if you're serious about building long-term wealth, mastering this area is non-negotiable. Habit number 8 that holds people back from building real wealth: waiting too long to invest. We've all heard the saying, the best time to plant a tree was 20 years ago, the second best time is today. The same truth applies to investing. I've seen countless clients stuck in what I call analysis paralysis, endlessly researching, waiting for the right time, or fearing they'll make a mistake. But in reality, the biggest mistake is doing nothing. One of my clients started modestly, just £500 a month into diversified index funds. 7 years later, that consistent habit grew into nearly £80,000, not through luck, but through time, discipline, and compounding. Here's the principle. You don't need to predict the market, you need to participate in it. That's where dollar cost averaging comes in, investing a fixed amount regularly, regardless of market conditions. It smooths out volatility and removes emotion from the process. For more experienced investors, diversification is key, spreading your investments across different asset classes to balance risk and return. And the simplest tip I give every client: start small. Stay consistent. Review yearly. Because wealth isn't built by timing the market, it's built by time in the market. Habit number 9, and perhaps the most dangerous of all, is not caring enough about your own money. Here's the real truth. If you don't manage your money, someone else will, and they'll make money off you. Banks, credit card companies, investment platforms, they all profit when you stay passive. Financial ownership isn't about obsessing over numbers. It's about taking responsibility for the life your money creates. I tell every client this: wealth is not the goal, freedom is. Freedom to choose how you spend your time. Freedom to support the causes you care about. Freedom to create impact that outlives you. And that starts with ownership, with deciding, today, that your financial story matters. You don't need to have it all figured out. Just take one small step, open that investment account, review your budget, learn one new concept this week. Because wealth doesn't grow from complexity, it grows from commitment. Take ownership, stay curious, and remember, your money should serve your goals, not control them. Let's recap. The 9 habits that quietly keep people broke and how the wealthy break them. 1. Paying yourself last. 2. Getting comfortable with bad debt. 3. Not having a financial buffer. 4. Not knowing your income and expenses. 5. Letting lifestyle inflation take control. 6. Believing saving alone builds wealth. 7. Paying too much in taxes. 8. Waiting too long to invest. And 9. Not taking ownership of your financial life. Whether you earn $30,000 or $3 million, these habits decide your financial trajectory. Wealth isn't luck. It's not timing. It's a set of systems, behaviors, and decisions repeated with discipline over time. So start small. Apply one habit this week, then another. Because every shift compounds, and that's how true financial freedom is built. If you found this valuable, let me know in the comments which topic you'd like next: tax strategy, investment planning, or wealth structure. And don't forget to subscribe for real-world financial insights grounded in strategy, not theory. Because in the end, wealth isn't about numbers. It's about habits, structure, and clarity. And it all starts the moment you decide to take ownership.